We just talked about the two most important financial decisions. Now let's move on to discuss about another important financial decision, that is dividend decision. Unlike debentures where you got to pay the interest irrespective of the profit or loss you're making, payment of dividend is at your company's discretion. Shareholders are surely going to expect dividends from you. But the decision as to when to pay and how much to pay depends on various factors or things happening in your company. Can you try answering what factors you would consider among these three before deciding on payment of dividends? Please look at the options on the screen and select the factors you would consider if you want to distribute dividends. Would you consider profits? Would you consider cash flows? Or would you consider the shareholder's preference? Now let's look at the answer. The first answer, profit, is right. Yes, you should consider profits and make sure you have enough profits to be distributed as dividend. So, consider profits before deciding to pay out dividends. The second answer, cash flow, is also right. Yes, you would consider cash flows or ensure that liquid cash is available with you to be distributed as dividends. But now you may ask me, why cash? Why not just profits? You're not taking just the profits because you shouldn't consider money which has been locked up in receivables or debtors, and this does not represent the real cash. The real cash is receivable from debtors sometime later when they actually make the payment. So, you shouldn't consider that. So, cash flow is a second important factor which has to be considered before deciding on paying out the dividends. If you had selected the third option, shareholders' preference, that is also the right answer, because certainly you would consider or listen to the preference your shareholder has. If they want you to pay them a stable dividend of an X amount, then you will be paying them a minimum amount every year irrespective of your profit positions. So, you have to pay it if they prefer it that way. So, apart from the three factors discussed above, there are 9 other factors which you will be considering before actually making the dividend payout decision. These 9 factors are as follows. Profit stability. You will be looking at the stability of your profit. What do you mean by stability of profits? Stability is the ability to maintain your profit. Take for an example that your company makes rupees 10 lakhs in 1 year. Then you are said to be stable if you could manage maintaining your profits at 10 lakhs or more in future years. So if you could make a good profit year on year and if you manage to maintain its stability, then you will pay them good dividends. The next factor is business growth plans. If you have plans to expand your business, then you may want money to expand it to buy new machinery or products. So, you may not want to go for external funding like raising equity or debentures, but you may prefer using the funds which is already available with you internally. And I'm talking about your retained earnings. So if you are planning for growth and you want to use up your retained earnings, then you may not be able to pay dividends. The next factor is taxation policy. What if I tell you your company has to pay taxes on dividends it is paying out to the shareholders? Yes, you heard it right. Paying taxes on dividend your company is paying to the shareholders. I can hear you saying, why should my company pay while the receivers are the shareholders? The answer is, it is possible and there are few provisions in the tax laws where the taxes are collected from the payer and not the receiver. You heard about taxes on salaries paid by your dad or mom. They paid because they are receiving the salary income. You're also aware of taxes on interest on bank deposits. But what do you think about the dividend they are receiving from companies? Are they taxed too? The answer is, dividends are not taxed in the hands of shareholders and they are taxed in the hands of the companies. Yes, companies have to pay taxes on dividends they are distributing. Since it is the obligation of companies to pay taxes, it may consider lowering the dividend payout if the taxes are more. Hence, rate of taxation automatically influences your decision on dividends. The next factor which influences dividend decision is market reaction. As a finance manager, you have to consider how the stock market will react if you declare low dividends. As you guessed it right, it definitely affects the market price of the share, making it a drop. On the other hand, the price of the share will increase if you are going to pay out more. So you have to take cognizance of this fact before deciding on the dividend payout. The next factor is the extent of access you have to capital markets. If you don't have proper access to capital markets to raise capital for your money needs, you may have to depend on your retained earnings for your company's money or financial needs. So in that case, you cannot distribute more profits as dividend and you need to retain a lot. But if you have a good access to the capital markets, you can meet your financial needs by raising capital and you may not depend too much on your retained earnings for your money or financial needs. So you have to consider the extent of access you have to capital markets before deciding on the dividend payout. The next factor is legal constraints. There are certain conditions imposed by law regarding distribution of dividends and you may want to consider it before making a decision. And the law referred to is Companies Act. The next factor is contractual payments. In some cases, your lenders may impose a restriction stating that you must not pay dividend unless or until your profits reach certain level or percentage. In that case, you are required to oblige the restrictions and take those restrictions into consideration before deciding on the amount to be paid as dividend. They do this to ensure that you do not make any default in the repayment of their loans or interest. The next factor is stable dividend policy. This means keeping dividend per share constant or stable irrespective of the profit positions. If you look at the difference between the shareholders' preference on stable dividend, which we discussed earlier, and the factor which we are discussing now, here the company willingly decides to keep the dividend per share constant. How do you calculate dividend per share? Dividend per share, shortly called as DPS, is the total dividend paid out in the year divided by number of outstanding shares. Outstanding shares are nothing but the shares currently held by shareholders. There are many companies who actually maintain stable dividend policy even today. So if your company policy talks about maintaining stable dividend every year, then you have to take that into account before deciding on the dividend payout. We just discussed about factors which have an impact on the company's dividend decisions. These factors influence the decision of the finance manager when he wants to declare dividend. The decision to pay out dividend would become faulty if the manager doesn't think about the above factors before making the decision. Next, we shall move on to discuss about a term called financial planning. Here we shall see how the company decides how much of money to borrow or raise. 10 crores, 15 crores or 20 crores? Well, the answer is quite simple. You raise money according to the financial needs of your company. Take for an example that your father wants to buy a villa and the price of the villa is 2 crores. What do you think are the sources from which he will arrange money? His personal savings? Or would he opt for a bank loan? Okay. Assume he takes 1 crore from his personal savings. How much do you think he will borrow from bank? 1 crore or 1.5 crore? 1 crore is the right answer. He doesn't want to borrow 1.5 crore, which is 50 lakhs more than his requirement, and the funds will remain idle in his bank account, gulping interest. In the same way, companies borrow only to the extent of their needs. But how do you determine their needs? A company is a huge organization and its operations are pretty huge. And not only that, you must also determine when exactly would the company need money. If the companies borrow or raise the money too early, they have to pay interest unnecessarily on the money borrowed, and this money will remain idle in the reserves if it is not put to proper use. So to approximately determine when you need the money, you must plan ahead and find out how much you need for next 1 to 5 years. Usually this kind of planning for money starts with a sales forecast. So why do you start with a sales forecast? The answer is, depending on how much of your products would sell, you would produce your product. Depending on the production, you will buy materials and machinery. And depending on the materials requirement, you will borrow or raise money. Also, sales forecast will help to arrive at profits which can be plowed back into the business as internal funds, thereby reducing the amount of funds raised from outsiders or from external funds. You may have plans to expand your business by buying new machinery and producing more to sell more 2 years down the line. You may want to start arranging for funds now so that money is made available to you at the right time. This is called as long-term plan. You have to note that you can plan only up to 3 to 5 years. More than 5 years, planning becomes unrealistic or difficult and it may not be proper. So, a long-term plan can be anywhere from 3 to 5 years. You can also make plans for short term, that is less than 1 year, and in this case it is called as budgets. Since the period is less than 1 year, you can estimate the numbers more accurately and you can prepare it in a detailed manner, listing out all the possible estimated expenses and income. To sum up, financial planning basically strives to achieve the two following objectives. To ensure availability of funds whenever required. This is done by estimating the required funds for different purposes, estimating the time when the funds are to be made available. And the second objective is to see that the firm does not raise funds unnecessarily. As already discussed, your company has to take care that funds are not raised in excess, that it remains idle. And even if you raised it, you should make best use of it. Finally, the official explanation of financial planning is this. Financial planning is the process of estimating the funds requirement of a business and also specifying the sources of funds. Why do you think it is important to plan your finances? There is one universal answer to this: to tackle uncertainty. You cannot say at the end of second year that you didn't know the demand for your company's products would increase so much in the market and so you're not prepared for producing it. It's not good, isn't it? Although you may not be able to exactly say by how much percentage your sales will increase, whether it is 20% or 30%, it is always possible for you to estimate the funds requirement if the growth is 20% or 30%. By preparing estimates in the different scenarios, you're actually preparing yourself well to handle those situations later when it really happens. That is the advantage of planning. By doing this, you will not be surprised or shocked when different situations arise than what you expected. Even if the sales drop to 10% or 5%, you must not panic. You should have a ready-made plan with you or steps to be taken with you before it is too late. Remember, you're running a business and running a business is like running a race and you cannot panic or stop in the middle, for your competitor will overtake you. While planning for sales, you're eventually planning how much to produce to meet the demand. You will also be planning simultaneously about the finances required to buy materials or machinery to meet the production requirement. So, there will be a lot of communication or coordination happening among these three departments, which is good for your company. A detailed planning helps to reduce waste, duplication of efforts, and it avoids gaps in planning. By planning, you're actually creating links between your investing and financing decisions, which is good. If you have meticulously planned and determined your sales growth as 20%, and if the sales has dropped to 10%, you can question the respective manager about why it has dropped. This way, it is easier for you to measure his performance. So, these are the importance of financial planning.